if you're just, wherever you are in your journey, if you're just getting started, what helped me a lot was realizing that I can do it. It was my own, I think, confidence back then of not knowing how or whatnot. Well, all that is teachable. Everything is learnable as well. So have the right mindset. Don't just think about it. At some point, you have to take the action piece as well. And if all these other people can do it, you can definitely do it as well.
If you're a real estate investor and are wondering how to raise and leverage private money to make more profit on every deal, then you're in the right place. On Raising Private Money, we'll speak with new and seasoned investors to dissect their deals and extract the best tips and strategies to help you get the money, because the money comes first. Now here's your host, Jay Connor.
Welcome to another amazing episode of Raising Private Money. I'm Jay Connor, your host, and this is the show where we talk about raising private money without having to ask anybody for money. Well, let me tell you something. I've got some amazing guests here on the show today here with me. We're fellow mastermind members. In addition to that, let me let you go ahead and know right up front that this dynamic duo, they have already raised over $10 million in private money since they've been in the real estate investing space. In addition to that, they have solely acquired over 240 apartments in just a few short years, and that spans across Canada, the United States, Mexico, and even Costa Rica. Now, the strategy that they use, and we're going to dig deep into that, the strategy they use actually gives them the ability to purchase properties without using any of their own money or relying on joint venture partners. So what does this do? Well, this allows them to own 100% of the property when they buy it, which means they keep 100% of the equity, 100% of the cash flow, and of course they get all the appreciation. Now, they've got over 23 years of combined experience in investing in real estate. They're the founders of the coaching and education company, what's called the Action Family TM Mentorship Program. They are totally dedicated to helping folks like you create their own time, location, and really get the financial freedom. They do this by helping other people build their real estate portfolios without using, as well, not their own funds, and they get to keep all the ownership as well. Now, to date, they have served and helped over 1,300 students to utilize their strategy across Canada and in the United States. Well, they both were able, because of this strategy, to quit their day jobs when they were only in their 30s. Well, following the debacle of the crash in 2018, they wrote 2 best-selling books. We'll get them to tell you about that as well. So along with being on podcasts such as this one, they've been on really, really big podcasts like Bigger Pockets. And of course, they're very, very well known on social media as well. In fact, got over 350,000 followers. So in just a moment, you're going to meet my good friends, this dynamic team duo, Mel and Dave Dupuis, right after this. Mel and Dave, welcome to the show.
Hey, Jay.
Hey, Jay.
So great to see you again.
Yes, thank you for having us.
So much for having us. We're super excited
Appreciate
to be here.
Absolutely. Well, thank you so much for having me on your show and then doing me the favor to come join me on my show as well. And so I can't wait to dive into your creative strategy that you use to acquire properties without having to use your own money, like I talked about in the intro. But before we get into that, I want to talk about raising private money a little bit. I mean, you've got a ton of experience in raising private money as well. But before we get to that, take us back to the beginning. How did your real estate journey actually begin?
Yes, well, let's rewind quite a few years here. So when I first met Dave, I had 2 properties. Dave had the 1 property, and we knew that we could somehow create wealth through real estate, but we weren't sure what and how. So we did what we thought was the best thing to do. We got to work. We started working all the time. We were both working 3 jobs. I was full-time at our local college, teaching part-time classes, fitness classes, and part-time at teaching college classes as well. Dave was a firefighter, a janitor,
teacher's aide, yeah.
And then we bought a couple properties, and then guess what happened? We ran out of money. So then we read the book Rich Dad Poor Dad when we were away on vacation, and we realized that we were doing it completely wrong. So although it didn't show us how to specifically do it, we realized that our mindset around it and that the way to get through it was using other people's money or creative financing to grow our portfolio. But I had a lot of fear, especially me, we both did, but I certainly had a lot of fear about using other people's money, because again, it is other people's money. It's somebody's hard-earned income that you are going to be using, that you have to make sure to pay them back. So I had a lot of fear around that. So we really developed a solid foundation. We call it the exit strategy, where you're going to be how to pay people back before you touch anyone's dollar, of course. And that was a life-changing year. After we did that, we bought 12 properties in 12 months. They're solely owned, so that was 56 units using none of our own money, no joint ventures. I think our bio is a little outdated on a few things, but yeah, we've purchased now over 250 units. We're now in 5 countries as well, and we're teaching people how to do the same as well.
That is amazing. Well, I've discovered that all of us investors that have used private money in the past or currently use it, what I've discovered is all of us have something in common most of the time, and that is something happened in your real estate investing business to where you realize that, you learn about private money some kind of way and you start using it. What happened in your real estate investing business to where you realize that, I need to learn about private money? Or how did you ever originally hear about private money? I never heard about private money until 2009 when I lost my line of credit, at the banks in 2009. But how did your journey with private money begin?
Okay, and I love that, Jay. So kind of like you had said on our podcast the other day, we were part of the bank starting to say no club, right? Yeah. The bank saying no more. So we had 5 properties. And our total debt service ratios, our credit score was good and everything was good. Our income was good, but we hit their certain threshold where head office said, no more. We were buying in our personal names back then as well, not in entities. And we hit the roadblock. So they said, no, thanks, but no thanks. So that forced us into the creative financing world. And what's funny, like you, Jay, is you were saying I hadn't heard about it till we had a mortgage broker. And actually I saw him a couple months ago, awesome guy. And he would always talk to us because there was another guy that was growing his portfolio very quickly. And he would talk to us about creative financing all the time and other people's money. And Mel and I, because Mel said she had a lot of fear in the beginning, we were worried, like, wait a minute, what is this? Is this illegal? Are we dealing with mafia? Like, what?
Dave was scared of going to jail. Let's put it that way.
I was like, yeah, I don't want to. I'm a firefighter. I don't want to go. I don't want to do anything offside. So we had heard about it. And then once we read the book, Rich Dad Poor Dad, I'm like, oh, people are doing this all over the place. And kind of dove deeper, and that's why we make that joke, right? But yeah, once we understood that and got no's from the bank, we studied it. We made sure to have our exit strategy, and that's kind of how we were pushed into creative financing. Thank goodness.
There you go. So when you started raising private money, of course, you've got multiple creative strategies that you use, and we want to dig into that here in a minute. But when you started raising private money, it's like, how did you start conversations, or how did you get, your first 1 or 2 lenders?
Yeah, I'll go ahead. The first one was really, it was owner financing. So number one was making sure that we understood it, right? So we spent a lot of time researching it and learning about it and all that. And then it was explaining, making it a win-win with the owner, right? Explaining why, like, they don't know us. The first person that lended us money, they didn't know us. And the first time we pitched it to somebody, it was far from perfect. We're human. It's still not perfect, right? There's always ways to improve. So a couple of times kind of went back and forth, and we'd come home and say, like, oh, you should have said this, or you should have said this. And we helped each other as well to help perfect our pitch, essentially. But it wasn't really pitching. It was because it wasn't pitching. It's a win-win. And I think as soon as we realized that it was a win-win for us, because we didn't have to come up with a down payment, it was a win-win for the owner because they could defer their capital gains, for example, over 5 years. And they got interest as part of it, and they were able to get perhaps close to full asking price, right? And most importantly, I had my exit strategy where I can show them how I'm going to be paying them back. That's how they were more than willing to do the deal. And quite often, interestingly enough, one deal, often, although they said this is my only property, once we paid them back, all of a sudden they say, hey, guess what? I have more properties. We're like, what? He's
I think
like,
we
yeah.
did 3 or 4 deals with that
So
guy. Yeah.
At first, he didn't tell us he had more than one building. He had held his cards close to him. And then he said, you know what? You paid me back on time. It was a very positive transaction. Let's do it again. And that's why it's so important when you're doing business to always make it a win-win and be very transparent with those you're doing business with as well.
Absolutely. So let's go ahead and dive into your creative strategies to how it works. Now, we talked about you own all these apartments now in all these different countries. So did you buy all these apartments with the seller carry back financing or owner financing, or did you buy some of them with private lenders coming along and funding the deals? Or tell us what that looks like. It may be all the above. We'll find out.
Yeah, it depends on the deal, kind of whatever the deal that requires, the pieces of the puzzle that we have to put together. So our favorite, yes, it is seller financing, owner financing, carry back. Everyone's got a different, but it all means the same thing. Basically, when the owner takes the equity that they have in the deal and holds financing. So that's our favorite. That's our go-to. We ask that on every deal. Not every deal says yes, but that is definitely our go-to, whether they're going to hold a first mortgage or a second mortgage. I always prefer when they hold the first mortgage, right? The lion's share, and then we come up with other private funds for the down payment. But so those will use registered funds in Canada, retirement funds in the US, like we had discussed, right? The self-directed IRA and the funds. So that's as well, has to be in the form of a mortgage. And then we'll also do promissory notes. But with the promissory notes, we'll make sure that they have some sort of security or collateral. Or, for example, we've done it where they've been named in our life insurance policy, right? So that they feel secure, or we don't go over leverage on the deal, making sure that if something happens in the exit, we still have enough meat on the bone in the deal that if we had to sell ASAP, everyone could still get paid. So pretty much all of the above.
We keep it very deal specific for that. Again, we've all heard those stories where people don't know what they're doing. They get excited and they don't have the exit, right? So that was definitely our foundation of growth. And a big part of it was also realizing that sometimes we're not always in buying mode. Sometimes we have to stop. And after a big growth, after 12 properties, 12 months, well, all of a sudden we have a lot of properties that we have to oversee for property
reposition and stabilize,
and stabilize and all that. So going through some growth and then stabilizing, and we've been doing that over and over again.
Sure. Well, my focus on the type of properties that I do are single family houses. And when I borrow private money, we call it one-offs, right? So do I have, I got a private lender, one or two that will fund that single family house. But with apartments, a lot of operators do what we call syndication. So are some of your deals, I would think, are syndicated?
We haven't gone that route. It's been mostly, and we've looked at it a couple of times actually, syndications and that. We haven't done it, but it's been more kind of one-offs, like you just said, Jay.
Well, that's a lot simpler. And
it's basically doing the BRRRR, right? Everyone knows buy, renovate, rent, refinance, repeat. I always got to remember.
Right.
So we do that, and we pick the deals that we know will be, like, let's say 12 to 24 months, meaning, Jay, you lend us money, we get into the asset, reposition it, change a few tenants over, do some cosmetic or gut job, whatever it needs, and then refi it to an A lender within that period of time to pay you out, and then we go do it again. So that's been kind of like you, kind of like the one-off. So it hasn't been syndications, no.
Gotcha. So it sounds like you're keeping all of these deals that you're doing. Like you're building like a huge portfolio, right?
Yes and no. Like we definitely kind of like the Monopoly game. Some of the properties that we've purchased out of the 250 units, we've definitely sold some throughout the years. So it just depends. Sometimes we will flip some. Sometimes we'll buy and hold, and we still. Dave's little house when I first met him, we still have that one, for example. Some of them we'll buy and hold for 5 years, and then either take or maybe sell it but overall, we like to buy and hold overall, but we're not afraid to sell if it makes sense to perhaps take that money, invest it in a different, bigger deal where we can get a nice new lift. So we've done a variety of buy and hold, flip and sell.
Right. So, so how many doors would you say you have?
Yeah, we still have over the 200 mark. We're still like, we actually got, it's fun because we're looking at a 10 unit in Costa Rica right now that was a hotel, and now we're going to make it into individual short-term rentals. And again, it's always, do we keep it? Do we refinance? Financing in Costa Rica is a little bit stickier. So it's really a moving number now, a moving target. Depends on what we acquire. And whenever we have our quarterly or monthly meetings with the accountants, we'll look at the asset corps, we'll look at the different things. And it's like, hey, what's making sense? Do we take the equity, go do something else? So that number's it's kind of fun. It's Monopoly in real life, right? It's always a moving number.
I love it. I love it. So let me make sure I understand your overall strategy or your intention when you do a deal, and you tell me if I got it right. So you locate a property, apartment complex that you're interested in. We're going to come back and talk about that in a moment as to how you find these deals, because whether it's single family houses or it's apartments, the two big questions are, how do I find the deals and how do I fund the deals, right? So you find an apartment that you're interested in, and your go-to is to talk to the owner about owner financing. That means they're the bank. They're financing that deal for you. And then you may use some private money in second position for down payment or renovations or, value add, bringing it up to par. And then in 12 or 24 months after you've got it up to par, you'll use a traditional lender for, for the refinance. That way you're going to hold on to it. You're going to pay off the owner if they did owner finance. You're going to pay off your private lender. And again, rinse and repeat and go find another apartment complex. Did I summarize that pretty good?
Yeah, good summary. Yeah, pretty much. Yeah,
you're bang on. Sometimes we use financial institution in first place that's open to creative financing as well. Sometimes we use secured funds, like in Canada, BRSPs, in the States, 401k. So we've done a variety of those as well. But yeah, essentially we make sure the deal makes sense, make sure our ratios make sense, so we can continue to get yeses from financial institutions, do deal specific, borrow that money, find deals that make financial sense with the exit strategy where we can force the appreciation. We never just count on natural appreciation. And then, refinance it or sell it, depending on the situation, pay back everybody else, and then we go do it again.
I love it. Well, what we're going to talk about next is how do you find these deals? But before we talk about how you find these deals, I want you to go ahead and share with our audience, in case somebody's got to jump off early. I want you to go ahead and share with the audience how to get in touch with you. And you've also got a free book that you're offering to give away. So tell everybody about that and give out the website.
Yeah, so we are all over social media. Our handle, Instagram, for example, is always Investor Mel Dave on all the platforms. We're on Instagram, we're on Facebook as well, and all the other platforms. You can find us there. And if you are interested, we're going to be talking, I'm sure, a little deeper into the strategies. But in this book, we dive even deeper into our book, and we'll be providing you with some additional information as well. You can go to www.iloveopm.com/book. It's an Amazon #1 bestseller. We actually wrote it after a horrific car crash. We never thought we were going to tell anybody how we're doing this before, but then we had a very bad highway crash, and then we decided to help other people do this as well. So go check it out. It's a short, tiny little book. You can read it in about 4 hours or so, depending on how quickly you read, but it's going to get you thinking bigger and understanding creative financing a little bit more.
I love it. So that URL for your book is www.iloveopm, for other people's money, iloveopm.com/book. And again, your social media, everything ends with Investor Mel Dave. So that's Instagram is Investor Mel Dave, Facebook, Investor Mel Dave, TikTok, Investor Mel Dave, and LinkedIn, Investor Mel Dave. Now I know why you got 350,000.
Well, I was going to say, I think my team maybe send an older version, because we're around 700.
I think we're over 720 or 750,000.
Good night. That's double.
We've been
I need to have a side conversation with you about how you're growing your social media. That is
absolutely, Jay. Let's chat.
Yeah, 100%, Jay.
That's fantastic. All right. So let's, by the way, if you're listening here to the show, be sure and download that book that they've offered. And if you're driving, of course, it's going to be in the show notes as well. You'll be able to take advantage of that. So let's dive into how in the world do you find these properties? I mean, for goodness sakes, all the way back in 2007, properties in 12 months, and that was like 56 units in just like 1 year when you were starting out. How do you find these deals, for goodness sakes?
You know what? Number one, I'd probably say I had the right mindset, right? We really we tuned in our mindset, knowing that, well, other people are doing this. There's essentially, we're all regular people, right? If they can do it, I can do it too. So we definitely decided to put a lot of work into this because we had a strong why. We have 3 kids. We knew someday we wanted to quit our full-time job. So we just, instead of looking at 5 deals a week, we 10x'd it, right? We looked at a lot of deals. We had a lot of conversations with a lot of people. We definitely got a lot of no's as well, right? Not every deal is going to make sense, or the exit strategy just wasn't there. And then, that's how we were able to continue looking off-market deals and working with investor-focused agents as well.
Mm-hmm. Got you. Have you got a resource you can share? I mean, I'm sure you got many resources, but is there a I don't even know if LoopNet is still around. People used to talk about LoopNet and stuff. Is there any kind of websites out there that you go and look for deals?
Well, honestly, and what we like doing, Jay, is it depends what we're doing. So if we're looking at a flip, we might look at hotter markets and also tertiary markets, because the numbers on flips can work kind of anywhere. I guess depends how you look at it. If we're looking for buy and hold rental properties that are going to cash flow, what we like doing is going to the secondary or tertiary markets, right? So like we live in a city that's 50,000 people. I know, Jay, you live in a smaller market as well. Like you can do deals anywhere, but we find that there's typically higher cap rates, lower purchase price. Depending, you want to make sure the vacancy is not too high, because I've seen some in Texas where it's like over 9 or 10%, even with amazing cap rates. But how are you going to raise the rents, and everyone's going to move out and you'll have no one to rent there anymore. So it's kind of like this fine line. So, but we love secondary markets. We love tertiary markets, higher cap rates. And then we'll start looking in there and asking for seller financing. So that's kind of our sweet spot, and using investor-focused real estate agents as well.
And not being afraid to ask and let people know what you're doing. So when we definitely did not have any kind of budget whatsoever for any kind of marketing back then, we did what was free, right? Having conversation with people. We used to have a little competition on handing out business cards when we go grocery shopping. I would always win, by the way.
Yeah, they'd rather talk to her than me, Jay.
But just letting people know. And it was fascinating, just from doing that regularly over a longer period of time, right? Not giving up after 2 days, how many people reached out to us, because the word just got around that, hey, the Dupuis are buying a lot of properties. I want to sell my building. I'm going to call the Dupuis. So just being consistent, looking at a lot of deals, and not being afraid to getting some no's, because sometimes that's part of being an investor.
Sure. When someone is starting out, in investing in apartments like you have, and you all have, trained and coached and educated a lot of people. What are some of the common mistakes that you see new investors making, getting into apartments and doing the business like you do?
Yeah, and thank you, Jay, for saying that. Our Action family is now just shy of 2,100 members. It's grown. Anyway, after that car crash, we had no idea when we created it, but something that I see a lot of is, Mel had mentioned earlier, the consistency, right? Someone will look for a deal for a couple of days and like, this doesn't work, or no one's lent me money, or I haven't found the ideal property yet. You might look for 10, 20, 30 days. Sometimes there's months we go by that there's no deals that meet our particular criteria that we want to invest other people's money in. But it's that consistency. And then don't be shy, like Mel said. So for example, like I'm just thinking back when we had zero budget and didn't know people, we'd pick a market that we want to be in. And there's always investor meetups, landlord meetups. Like there's always things that you can go to start learning for free, start having conversations. You're going to meet property managers there that might have clients that are looking to liquidate. You might meet other owners that are possibly looking at selling, and maybe their kids or their beneficiaries are not interested. You might be able to pick things up. So those are the easier low-hanging fruit that I would say, just don't give up and do those kind of things. Be around people that are in real estate, right? I'm not saying all their not all information is good information, but
no, but your network is your network,
Yeah.
right? We have a lot of members that are doing great things together. For example, you never know who you're going to meet. That maybe I have a bill. I mean, I've heard. Okay, interesting here, Jay. Story time. We actually purchased. Didn't see this coming. So, two ladies from New Jersey joined our Action Family program years ago. They were buying properties in New Jersey. Fast forward down the road, now they're doing a project development in Dominican Republic, and we actually ended up buying two units, two penthouses from them as well in Punta Cana. So that's the power of your network, right? Like I wouldn't have seen that. I would have been exposed to these deals if I didn't have that strong network. So your network is your network. Definitely, never forget the importance of that. You never know what's going to come out of it, and if you make it a win-win for everyone, it's very powerful.
Well, tell us about the Action Family network that you've got. What is that? What's it look like?
Yes, the Action Family essentially is for those who want to learn how to do what we do, right? So we teach people how to buy properties using, again, creative financing and without joint venture partners. And there's a combination of videos that they can watch at any time, of a lot of templates or cash flow matrix with the exit strategy that's been trademarked. They get access to weekly live sessions as well with Dave. And now we're over 2,000 members in the community they can network with as well, and in the daily Q&A inside the group with Dave and I. So we're very, very active with our community. There's questions every day, so we love it.
All right. Well, that's fascinating. And again, how can people learn about the Action Family?
Yeah, if somebody's interested, they can just send us a DM on any social media, or they can go to our website as well, investormeldave.com, and contact us through there.
All right, perfect.
Yeah, there's some free videos there as well they'll be able to check out. So
love it. So that's investormeldave.com. Now, when you are analyzing an apartment that you're interested in investing in, give us the 30,000 or maybe the 50,000 foot view of how do you, and I know there's a lot of details that go along with this, but when you're looking, what are some of the first things that you're looking at to analyze that deal to see if it looks like a viable deal?
So, yeah, I love that, Jay. So to give you the 30, 40, 50,000 foot
and I know
level,
I just asked you a 3-day seminar question.
Well, and I love it though, because this is something I'll reverse engineer. So in the US, we primarily were Texas, Florida, and recently Ohio. In our opinion, we want to be in a more investor-friendly, landlord-friendly state. So we start off there, right? Then from there, we'll look at properties, for example, that have higher cap rates, right? If we're going to do a buy and hold, a BRRRR on a multifamily. So something that has a higher cap rate. And then tertiary market, like we mentioned. Then when we go deeper, it's, okay, can the rents be increased, right? Can we actually lift this asset with increasing the income or doing, some minor cosmetics? Sometimes we do full gut jobs, but I'd rather have that lower hanging fruit, just cosmetics. So can we literally lift the asset in appreciation by doing either of those? How much is it going to cost? And like I mentioned earlier is, if we do start increasing, let's take a 10plex, for example. If we do increase the rent on all 10 of those tenants, what is the vacancy rate? If it is a lot higher and they all walk, then we're stuck holding that building and all the carrying costs. So it's just finding those. Once you start determining, hey, nothing over a certain amount of vacancy rate, I'm okay with. Nothing under a certain cap rate. So we have those parameters and we kind of stay within them, Jay, and that's kind of how we do deals. And if it works, awesome. We'll ask for seller financing. And then if the deal doesn't work, we're not afraid to walk away and keep on looking for the next one. Yeah.
As you were going through that explanation, I had a saying that bubbled up in my mind that I tell people all the time, and that is, the math makes the decision, not your emotions.
Yes.
And in fact, that's a common mistake that I've seen with people starting out, even in single family houses. They're so excited about getting started, they pay too much for the property.
100%. It has to be numerical. It has to be strategic. Take the and I mean
this, not this.
And
right?
we've admittedly almost did the mistake.
There's some buildings that I love, and I just keep running the numbers. I'm like, please, the numbers change.
The big,
don't.
Beautiful, perfect looking building. I'm not saying you can't cash flow from them, but we had looked at one that we almost purchased but it was making the same amount as a duplex. I'm like, why am I buying this 20plex, making the same amount and a whole lot more work and a lot more effort and all those things, right? So it's really looking at your numbers, getting your ego a little bit, put it aside, put your emotions aside, and does the deal make sense? So I love it, Jay. We're on the same page. Yeah.
Let the math make the decision.
Yes.
Well, Mel and Dave, it has been such a wonderful pleasure having you here on the show. And any final words or final advice you'd like to share before we sign off?
I would just like to share that, if you're just, wherever you are in your journey, if you're just getting started, what helped me a lot was realizing that I can do it. It was my own, I think, confidence back then of not knowing how or whatnot. Well, all that is teachable. Everything is learnable as well. So have the right mindset. Don't just think about it. At some point, you have to take the action piece as well. And if all these other people can do it, you can definitely do it as well.
Awesome. Thank you so much, Mel. Thank you so much, Dave. And God bless you.
Thanks so much.
Thanks, Jay.
All right. Look forward to seeing you in person at our next mastermind get together. Well, there you have it. Another amazing episode of Raising Private Money. And we really need your help. If you happen to be watching on YouTube, be sure and ring that bell. If you're listening on any of your platforms, your favorite podcast platforms, be sure to follow so you don't miss out on any of the other upcoming episodes. Be sure to like and share and spread the good news. So there you have it. I'm Jay Connor, the Private Money Authority, wishing you all the best and look forward to seeing you right here on the next episode of Raising Private Money.
Are you feeling inspired by the knowledge you gained in this episode? Then head over to jconnor.com/moneyguide. That's jconner.com/moneyguide and download your free guide that shares 7 reasons why private money will skyrocket your real estate investing business right now. Again, that's jconnor.com/moneyguide to get your free guide. We'll see you next time on Raising